December 19th, 2024, a date that passed quietly across mainstream headlines, unnoticed by most people scrolling through their phones. No breaking news banner, no emergency broadcast, no market halt alarms. Yet behind closed doors, in trading desks, supply chain war rooms, and sovereign vaults, alarms were already screaming. Because on that day, the global silver market didn't wobble. It broke. Mexico, the world's largest silver producer, issued a presidential decree that fundamentally altered the flow of one of the most critical industrial metals on Earth. This was not a temporary mining pause, not a labor dispute, not a weather disruption. It was a state-level intervention. A single document that instantly removed nearly 190 million ounces of annual silver supply from global circulation. To understand why this matters, you must first understand one uncomfortable truth. Silver is not a luxury metal anymore. It is not jewelry. It is not coins. Silver is infrastructure. Every smartphone, every electric vehicle, every solar panel, every satellite, every military guidance system, they all depend on silver, and there is no substitute. And yet, the global system has been operating under one fatal assumption: that silver would always be there. That assumption just collapsed. For decades, Mexico has sat at the center of the silver universe. Not because it wanted power, but because geology gave it power. Mexico produces more silver than China, Peru, Australia, Russia, and the United States combined. In some years, it has supplied over 23% of global mined silver. Entire industrial supply chains were quietly engineered around the idea that Mexican silver would always flow. But in December 2024, that flow stopped. The decree did not say ban in bold letters. It did not announce nationalization. It did not declare an export embargo. Instead, it used a far more dangerous mechanism: extraordinary regulation. A legal framework that allows the state to suspend, revoke, or indefinitely delay mining permits under the justification of national security, environmental emergency, or social instability. On paper, it sounded administrative. In reality, it was absolute. Mining operations found their water permits frozen. Environmental renewals delayed indefinitely. Transport authorizations under review. Security clearances suspended. Mines were not seized. They were strangled. Within weeks, production lines went dark. Refiners stopped receiving concentrate. Export terminals sat idle. And traders realized something horrifying. There was no alternative supplier. The silver market is not like oil. Oil has strategic reserves. Silver does not. Oil has substitution pathways. Silver does not. Oil futures are mostly paper. Silver futures require physical delivery. And this is where the crisis truly began, because silver is the most shorted commodity on Earth. For years, paper-silver contracts, futures, ETFs, derivatives have represented hundreds of ounces for every single ounce that actually exists. The system worked only because physical supply kept arriving. Mexico was the anchor. When that anchor was pulled out, the math collapsed. Traders who assumed Mexican silver would refill inventories suddenly faced delivery obligations they could not meet. Vaults that were already near empty realized there was no refill coming. And the word no market ever wants to hear started spreading. Unobtainable. But why would Mexico do this? Why would a nation so dependent on mining revenue risk destabilizing global markets? The official explanation was environmental. Water scarcity, aquifer depletion, drought stress, all true. But incomplete, because water issues did not begin in 2024. Cartel violence did not begin in 2024. Resource nationalism did not begin in 2024. What changed was timing. Mexico was facing a convergence of pressures that made continuation impossible. Mining regions had become war zones. Cartels were extorting operators, hijacking shipments, and taxing production more efficiently than the state itself. In some regions, miners were paying 3 layers of protection: private security, government fees, and cartel permission. At the same time, water levels fell to historic lows. Silver mining is water intensive. and rural communities, already under stress, began turning hostile. But beneath all of this was a deeper shift, a strategic one. Mexico was no longer comfortable being just a supplier. It wanted leverage. Globally, the world is fragmenting into resource blocks: energy, food, rare earths, metals. And silver sits at the intersection of all three. It is both an industrial input and a monetary metal, which makes it uniquely powerful. Inside Burek's circles, silver has been quietly discussed as a settlement metal, not as a reserve like gold, but as a trade stabilizer. You cannot build a green economy without silver. You cannot electrify transportation without silver. You cannot maintain military superiority without silver. By restricting supply, Mexico did not just raise prices. It changed negotiating power. Suddenly, tech giants were not buyers. They were petitioners. Tesla's problem was immediate. Electric vehicles use between 25 to 50 grams of silver per car. Solar panels use even more. By early 2025, manufacturers realized that inventories had been optimized for just in-time delivery, assuming constant silver availability. That assumption died. Warehouses were not stocked. Contracts were not protected. And recycling could not scale fast enough. Silver recycling takes time, infrastructure, capital, years, not weeks. Which meant one thing: production cuts were inevitable. As this realization spread, the financial markets reacted violently. Silver futures spiked. Premiums on physical bars exploded. Mints halted sales. Retail dealers ran out of inventory. And still, paper markets pretended nothing was wrong, until delivery notices started failing. Until contracts rolled forward because metal could not be sourced. That is the definition of a short squeeze. Not price speculation, not hype, but physical absence. And this is where history offers a warning. Every time silver supply has been constrained, not slowed, but constrained, prices did not rise gradually, they reset. Because silver is not priced by abundance. It is priced by scarcity, and scarcity had just gone exponential. By early 2025, analysts began adjusting models. 30 silver no longer made sense. The 4 dozen silver looked conservative. Then the unthinkable entered mainstream research notes: 50 silver, or 75 silver, even a 100 silver scenarios. Not because of inflation, but because the market was discovering that most silver had already been consumed. Unlike gold, silver is not hoarded. It is used, lost, discarded, trapped in landfills and electronics. Which means above ground silver stocks are dangerously thin. Mexico's decree exposed that fragility, and the world is now racing to adapt. But adaptation takes time. And time is exactly what the silver market does not have. Because demand is not slowing. Green energy mandates are accelerating. EV targets are increasing. Military budgets are expanding. And AI infrastructure requires more conductive metals than ever before. Silver demand is rising. Supply just fell off a cliff. This is not a cycle. It is a regime change. And we are only at the beginning. Because Mexico is not alone. Other resource-rich nations are watching closely. And what Mexico proved is simple. You don't need to ban exports. You just need to control permits. And suddenly, the world listens. The global market initially failed to recognize the significance of the Mexico decree because it did not resemble any traditional form of state intervention. There was no announcement of a ban, no declaration of nationalization, and no visible seizure of assets. Mining operations were not forcefully shut down. Exports were not publicly halted, and ownership structures remained intact. Instead, the decree operated quietly through administrative authority, a method far more effective than outright prohibition. Its strength lay not in what it openly restricted, but in what it redefined as conditional. The decree was issued under a legal framework classified as an extraordinary regulatory adjustment for strategic natural resources. Under Mexican law, this designation activates emergency executive authority, allowing the federal government to override existing commercial, environmental, and operational permissions when national interests are deemed at risk. These interests include environmental preservation, national security, social stability, and long-term resource sustainability. Once such authority is invoked, approvals can be suspended or delayed indefinitely without triggering seizure, compensation, or fixed review timelines. This legal structure was carefully chosen as it minimizes exposure to domestic legal challenges and international arbitration. One of the most impactful mechanisms within the decree involved water use authorization. Silver mining is heavily dependent on water, not only for extraction, but for ore processing, waste management, and environmental compliance. The decree granted federal agencies the power to reassess all water permits in designated mining regions. Importantly, these permits were not revoked. They were simply placed under reassessment, a process with no defined deadline. Without active water authorization, mining operations automatically fall out of regulatory compliance, making continued operation illegal. Milling stops, processing halts, and environmental obligations become impossible to meet. In effect, mines were not shut down, but they could no longer legally function. Simultaneously, large silver producing regions were reclassified as ecologically sensitive transition zones. This reclassification imposed new regulatory obligations on operations, regardless of how long they had been active. Mines that had operated legally for decades were suddenly required to conduct fresh environmental impact studies, undergo expanded federal reviews, and initiate new community consultation processes. These studies typically require between 12 and 36 months to complete, assuming no delays. However, such assessments cannot proceed without valid water permits, creating a closed regulatory loop that prevents progress while maintaining legal justification. The decree also introduced new security compliance standards for operations involving strategic natural resources. On paper, these standards addressed labor safety, logistics protection, and transport security. In practice, they imposed an unspoken requirement that companies demonstrate freedom from criminal interference. In several mining regions, this condition was impossible to certify. Admitting the presence of cartel influence would violate legal and contractual obligations, while failing to prove its absence rendered operations non-compliant. As a result, many mines became legally uncertifiable and were forced into suspension without formal closure. Within 2 months of the decree's implementation, the operational impact became visible. More than 70% of Mexico's primary silver mines reduced output or halted production entirely. Concentrate shipments declined sharply, and refiners increasingly turned to scrap and recycled materials as primary ore supplies diminished. No official shutdowns were announced, yet production collapsed across the sector. By early 2025, it was clear that the disruption was not temporary and could not be resolved quickly. The timing of the decree amplified its global impact. For more than a decade, silver prices had remained suppressed relative to production costs. Mining margins were thin, exploration budgets were reduced, and new project development slowed significantly. Global silver supply became increasingly dependent on aging legacy mines, particularly those in Mexico. When this supply was constrained, there were no immediate alternatives. Other major producers faced their own limitations. Peru struggled with political instability, China prioritized domestic consumption, Russia redirected metals toward strategic partners, and Australia focused capital investment on gold. Mexico's role as a keystone supplier meant its withdrawal exposed a lack of redundancy in the global system. Underlying the decree was the reality of criminal influence in mining regions. In several areas, cartels had evolved beyond organized crime into parallel power structures. They controlled transport routes, imposed informal taxation, and exerted influence over labor and logistics. Some mining operations faced extortion costs estimated at 15 to 20% of production value. Rather than engaging in direct confrontation, which risked escalation the state reduced the economic incentive structure by restricting mining activity. By limiting operations, cash flow in contested regions declined, and the strategic value of mining corridors diminished. The decree functioned as a containment strategy rather than an enforcement campaign. This approach reflects a modern form of resource nationalism. Instead of seizing assets or banning exports, the state exercised control through permits, environmental standards, and compliance certification. This method avoids sanctions and diplomatic backlash while maximizing leverage. Mexico did not claim ownership of silver reserves. It asserted authority over the conditions under which those reserves could be accessed. Market stress indicators emerged gradually. Initial price reactions were muted, but a divergence soon appeared between paper and physical silver markets. Premiums on physical metal rose sharply, delivery times lengthened, and cash settlements increasingly replaced physical delivery. These signals indicated that while futures markets continued to trade normally, physical availability was tightening. Such divergence is a classic sign of structural imbalance. The underlying vulnerability lay in the paper-silver system. Estimates suggest that for every ounce of physical silver, there are between 100 and 250 ounces of paper claims. Futures contracts, exchange, traded products, and unallocated accounts rely on the assumption that most holders will never request delivery. When physical supply diminished, that assumption weakened. Requests for delivery increased, exposing the fragility of the system. Substitution offered no immediate solution. Silver possesses the highest electrical and thermal conductivity of any metal and plays a critical role in high-performance electronics, energy systems, and defense applications. Alternatives reduce efficiency, reliability, and safety. In many strategic industries, substitution is not acceptable. As a result, demand remains largely inelastic, even as prices rise. By mid-2025, industrial responses reflected this reality. Solar manufacturers delayed expansion plans, electric vehicle producers revised cost projections upward, and defense contractors secured long-term supply agreements at elevated prices. Silver began transitioning from a traded commodity to a strategic material, governed more by availability than by price. The decree did not ban exports, nationalize reserves, or confiscate assets. What it did was establish precedent. It demonstrated that control through regulation can be more effective than control through ownership. The global system is now adjusting to that reality, and the consequences are only beginning to unfold. What transformed the Mexico decree from a regional policy decision into a global systemic event was not mining alone, but the broader geopolitical environment into which it landed. The world economy had already entered an era defined by fragmentation. Supply chains that once assumed global cooperation were being reshaped by strategic rivalry, sanctions, and competing monetary visions. In this environment, control over physical resources became more valuable than control over currencies or financial instruments. Silver, sitting at the intersection of industry, technology, and monetary history, became uniquely exposed. Within emerging multipolar frameworks, particularly among non-Western economic blocs, silver began to be viewed differently. Gold remained the anchor of long-term reserves, but silver occupied a separate role. It was discussed not as a store of wealth for central banks, but as a settlement and industrial stabilizer. Unlike gold, silver is consumed. It flows directly into manufacturing, energy systems, and defense infrastructure. This makes it both harder to stockpile and more powerful as leverage. Restricting silver supply does not merely raise prices, it directly constrains production capacity across multiple sectors. In this context, Mexico's decision aligned with a broader global pattern. Nations rich in strategic resources increasingly sought to shift from being passive suppliers to active participants in value determination. For decades, resource Producing countries exported raw materials while price discovery occurred elsewhere, primarily through Western financial markets dominated by derivatives and futures contracts. The Mexico Decree implicitly challenged that model by asserting that physical availability, not paper liquidity, defines value. The implications for the US dollar-centric system were subtle but profound. The dollar's dominance relies on predictable access to real goods in exchange for financial claims. When physical commodities become constrained, financial claims lose credibility. Silver exposed this vulnerability because it is deeply embedded in the real economy while simultaneously being heavily financialized. Futures markets, exchange, traded funds, and unallocated silver accounts created the illusion of abundance. The decree punctured that illusion. As physical supply tightened, a structural divergence emerged. Paper silver continued to trade in high volumes, but physical silver increasingly required premiums, delayed settlement, or alternative arrangements. This divergence signaled a breakdown in price discovery. The quoted price no longer represented the cost of obtaining metal, it represented the cost of holding a claim. That distinction became critical for industrial buyers who required delivery, not exposure. The stress propagated outward. Manufacturers realized that long-term supply contracts were vulnerable to regulatory intervention upstream. Just-in-time inventory systems, optimized for efficiency rather than resilience, proved fragile. Silver inventories across the industrial sector were far lower than assumed, often measured in weeks rather than months. Recycling provided some relief, but recycling infrastructure cannot scale quickly, and much of the world's historical silver stock is irretrievably dispersed in small electronic components. Defense sectors responded first. Military procurement cannot tolerate supply uncertainty. Governments quietly prioritized silver allocation for strategic uses, further tightening availability for civilian industries. Energy systems followed. Solar panel manufacturers faced rising costs and shrinking margins, forcing delays and cancellations. Electric vehicle producers revised timelines and pricing models. Each adjustment fed back into broader inflationary pressures, not through monetary expansion, but through material scarcity. At the same time, investors began reassessing silver's role. For years, silver had underperformed relative to gold, reinforcing the perception that it was abundant or easily replaceable. The Mexico Decree forced a reevaluation. Investors who previously viewed silver as a speculative metal began treating it as a strategic asset. Physical ownership gained importance relative to paper exposure. This shift increased pressure on already thin inventories. Central banks did not respond publicly, but their silence was notable. Unlike gold, silver is not held in significant quantities by central banks, which meant there was no institutional backstop. The market was forced to self-correct. Prices began reflecting scarcity rather than sentiment. Volatility increased, not because of speculation, but because supply and demand were no longer mediated smoothly. The precedent established by Mexico also altered expectations elsewhere. Other resource-rich nations observed the effectiveness of regulatory control. No expropriation was required. No international crisis erupted. Yet leverage increased dramatically. This realization raised the probability that similar approaches could be applied to other strategic materials, from copper to rare earth elements. The global economy, built on assumptions of continuous material flow, faced a new kind of risk administrative scarcity. Silver's dual identity intensified the effect. As an industrial input, it cannot be hoarded indefinitely without economic cost. As a monetary metal, it carries historical significance and psychological weight. When these roles converged under conditions of scarcity, market behavior changed rapidly. Silver was no longer merely a component of products, it became a bottleneck. By late 2025, it was increasingly clear that the silver market had entered a different phase. This was not a cyclical shortage driven by demand spikes or temporary disruptions. It was a structural adjustment driven by policy, geopolitics, and long-term underinvestment. Prices adjusted not to incentivize marginal supply, but to ration demand. The Mexico Decree did not cause all of these dynamics, but it revealed them. It acted as a catalyst, exposing vulnerabilities that had accumulated quietly over years. The global system had treated silver as infinite because it was inexpensive. It had priced abundance into contracts, technologies, and timelines. When that assumption failed, the adjustment was abrupt. What followed was not panic, but repricing. Industries learned that cost was no longer the primary variable, access was. Investors learned that paper exposure carried different risks than physical ownership. Governments learned that regulatory authority could shape markets more effectively than force. This shift marked the beginning of a new phase in the global commodities landscape. Silver, once overlooked, became a case study in how modern supply chains respond to constraint. The consequences of that shift continue to unfold, reshaping industrial planning, financial markets, and geopolitical strategy in ways that extend far beyond a single metal. As the structural nature of the silver disruption became undeniable, market mechanics began to change in ways that traditional models failed to capture. Silver pricing had long been dominated by futures markets, where volume and leverage far exceeded physical availability. This system functioned only as long as confidence in delivery remained intact. Once supply from Mexico constricted, that confidence eroded quietly but steadily, altering behavior across every layer of the market. Price movements initially appeared modest relative to the scale of the disruption. This led many observers to dismiss the situation as overhyped. In reality, prices were being suppressed by legacy mechanisms that no longer reflected physical conditions. Futures contracts continued trading based on historical liquidity assumptions, while physical silver increasingly traded on separate terms. This created a bifurcated market in which quoted prices lost their meaning for industrial buyers who required actual metal. As delivery risk increased, exchanges responded by adjusting margin requirements, settlement rules, and delivery incentives. These measures were framed as routine risk management, but their effect was to discourage physical settlement. Cash settlement became more common, and rolling contracts forward replaced fulfillment. Each adjustment reduced immediate pressure, but increased long-term fragility. The system was buying time, not solving the underlying shortage. Industrial users responded rationally. Rather than relying on spot markets, they sought long-term bilateral agreements, often directly with refiners or recycling operations. These agreements frequently bypassed public pricing entirely, relying instead on negotiated premiums and guaranteed delivery clauses. As a result, an increasing share of silver supply moved off transparent markets and into private channels. This reduced visible liquidity and amplified volatility for remaining participants. Recycling emerged as a critical but limited response. While silver is technically recyclable, the process is constrained by collection, separation, and processing capacity. Much of the world's silver exists in trace amounts embedded in electronics, solar panels, and industrial components. Recovering it is economically viable only at higher prices and requires years of infrastructure investment. Recycling could alleviate some pressure, but it could not replace lost primary supply in the near term. Mining investment, often cited as the eventual solution, faced similar delays. New silver mines require extensive permitting, capital investment, and development timelines measured in years, not months. Moreover, the regulatory precedent set by Mexico increased perceived sovereign risk. Investors now had to price in the possibility that future production could be constrained by policy rather than geology. This raised the cost of capital and slowed project approvals, further limiting future supply. As these constraints converged, price behavior shifted. Instead of responding to marginal demand changes, silver prices began reflecting availability thresholds. When inventories dropped below critical levels, prices moved sharply upward to ration demand. When temporary relief appeared through recycling or reduced industrial activity, prices stabilized but did not return to previous ranges. This pattern signaled a regime change from abundance pricing to scarcity pricing. Forecasts adjusted accordingly. Analysts who previously relied on cost of production models found them insufficient. The marginal cost of mining no longer defined price floors. Access risk defined price ceilings. Scenarios once considered extreme entered mainstream discussion. Silver at $50 per ounce was no longer framed as speculative excess, but as a level required to balance constrained supply against non-negotiable demand. Higher projections reflected not optimism, but recognition of structural imbalance. Financial instruments struggled to adapt. Exchange, traded funds backed by physical silver faced scrutiny as investors questioned whether underlying metal was fully accessible. Unallocated accounts lost appeal as counterparty risk became more apparent. Physical ownership gained prominence despite higher premiums and storage costs. This shift reduced available float, tightening the market further. Volatility increased, but its character changed. Price swings were no longer driven primarily by sentiment or macroeconomic indicators. They were driven by inventory reports, delivery delays, and regulatory developments. Each announcement related to mining permits, environmental reviews, or security conditions carried outsized impact. The market became hypersensitive to supply-side signals. Governments monitored these developments closely. Silver's role in defense, energy transition, and critical infrastructure elevated it to strategic importance. Quiet coordination emerged between industrial policy and resource access. In some cases, silver allocation decisions were influenced by national priorities rather than market bidding. This further distorted traditional price discovery mechanisms. The cumulative effect was a gradual decoupling of silver from conventional commodity cycles. It no longer behaved like a metal responding to economic growth or contraction. Instead, it behaved like a constrained input whose value was determined by policy, security, and long-term planning. This decoupling confused participants accustomed to cyclical patterns and reinforced the sense that the market had entered unfamiliar territory. The Mexico Decree remained central to this transformation, not because it alone caused scarcity, but because it revealed how little slack existed in the system. It demonstrated that a single regulatory decision applied at a critical node could reverberate globally. The lesson extended beyond silver. It highlighted the vulnerability of modern supply chains to administrative control and the limits of financial abstraction when confronted with physical reality. By the end of this phase, it was evident that the silver market was no longer searching for equilibrium within old boundaries. Those boundaries had shifted. Prices, contracts, and strategies adjusted not toward a return to normalcy, but toward a new baseline defined by constraint. Participants who recognized this early adapted. Those who did not continue to rely on models built for a world that no longer existed. As the silver market adjusted to its new constraints, attention gradually shifted from immediate disruption to long-term consequences. What initially appeared as a supply shock evolved into a broader reassessment of how modern economies secure critical materials. Silver became a reference point in discussions about resilience, sovereignty, and the limits of globalization. The question was no longer whether prices would rise, but how systems would adapt to a world in which access to essential inputs could no longer be assumed. One of the most significant developments was the reassessment of industrial planning horizons. Companies that once operated on quarterly procurement cycles began extending forecasts to multiple years. Long-term contracts replaced spot purchases, and supply security became a board-level concern rather than a procurement detail. This shift altered corporate behavior across sectors, from electronics to renewable energy, embedding material risk into strategic decision-making. Governments responded unevenly. Some moved quietly to classify silver as a critical material, integrating it into national resource strategies. Others relied on market mechanisms, assuming that price signals alone would resolve shortages. The divergence reflected broader philosophical differences about state involvement in resource allocation. Where silver was deemed strategic, intervention increased. Where it was not, exposure to volatility grew. Financial markets struggled to reconcile these changes with existing frameworks. Traditional commodity analysis relies on elasticity assumptions that break down under strategic constraint. Silver's demand profile defied easy categorization. Industrial usage was non-discretionary in key sectors, while investment demand surged precisely because of that inflexibility. This feedback loop intensified scarcity, reinforcing upward pressure without the usual dampening effects of substitution or demand destruction. Systemic risk emerged not from any single failure, but from accumulation. Each delayed delivery, each renegotiated contract, and each regulatory review added friction. Individually, these events were manageable. Collectively, they altered the tempo of global production. Projects slowed. Costs rose. Timelines stretched. The economy absorbed these changes gradually, masking their origin but amplifying their impact. In energy systems, the implications were particularly pronounced. Renewable infrastructure depends heavily on silver for efficiency and reliability. As costs increased, some projects became marginal. Delays accumulated, complicating energy transition targets. Policymakers faced a paradox. Accelerating green mandates increased silver demand, while constrained supply raised the cost of compliance. This tension forced difficult trade-offs between ambition and feasibility. Defense sectors, insulated from price sensitivity, exerted disproportionate influence. Their willingness to pay premiums redirected supply, crowding out civilian uses. This prioritization was rarely publicized, but its effects were visible in market tightness. The allocation of silver increasingly reflected national security considerations rather than market equilibrium, reinforcing the perception that the metal had crossed into strategic territory. The monetary dimension resurfaced as well. Although silver is no longer a formal currency anchor, its historical role lent symbolic weight to its scarcity. In regions skeptical of dollar dominance, silver's physicality offered appeal. It represented value outside financial systems, immune to digital controls and sanctions. While not replacing gold, it complemented broader efforts to diversify settlement mechanisms and reduce reliance on abstract claims. This dynamic unsettled established financial centers. Markets built on liquidity and leverage depend on confidence in underlying assets. As silver's availability tightened, confidence in derivative representations weakened. Regulatory bodies faced pressure to increase transparency, but transparency alone could not create metal. The gap between representation and reality became harder to ignore. Over time, adaptation replaced shock. Supply chains reorganized around constraint rather than abundance. Recycling infrastructure expanded, though slowly. Research into material efficiency intensified, seeking to reduce silver usage per unit without sacrificing performance. These efforts mitigated pressure, but did not eliminate it. Gains were incremental, while demand growth remained structural. The broader lesson extended beyond silver. It underscored the fragility of systems optimized solely for efficiency. Just in time logistics, financial abstraction, and global specialization had delivered low costs, but at the expense of resilience. When a critical input was constrained by policy rather than price, those systems struggled to respond. Silver became an example cited in policy debates, academic research, and corporate risk assessments. The Mexico Decree continued to loom in these discussions, not as an isolated act, but as proof of concept. It demonstrated that sovereign decisions, even when framed as administrative or environmental, could reshape global markets. It highlighted the power of regulatory tools in an era where overt nationalization is politically costly.